Hi everyone, this is Steve Elwell from Level Financial Advisors, the Chief Investment Officer, and we thought we'd spend a little time today talking about the debt ceiling since that's a lot in the news recently. I know we spoke a little bit with a video we did back in January, and we also touched on it in the quarterly commentary, but we thought we'd show some pretty charts today to talk about what happened the last couple of times that we had some debt ceiling issues. So as a reminder, the debt ceiling is a self-imposed limit on the amount of debt that the U.S. government can borrow. So it would be as if you and your spouse said just randomly, we're only going to allow ourselves to borrow $50,000. Even if a bank may say, oh, well, financially you're responsible enough you could borrow $500,000, you are self-imposing a limit on how much it is that you can borrow. So it's not actually an authorization to randomly go spend money on different things. It's just a limit, a self-imposed limit on the debt. So when we think about that, as the U.S. economy gets bigger and bigger, which normally it does, it usually grows at 2 or 3% a year, that debt ceiling needs to get bigger and bigger to be able to fund all the government's operations. So over time, generally, every 1 or 2 years, they raise the debt ceiling to be able to allow the government to continue to function. Since the creation of the debt ceiling, which was way back in 1917, something like 90 times they've raised the debt ceiling. In most of those times, nobody even really paid much attention. It wasn't a political fight. There wasn't a big hoopla about it. In fact, traditionally, it's been a nonpartisan debate about raising the debt ceiling. It's more of a logistical thing that needs to be done to allow the government to continue to function. But there have been several instances where the U.S. has approached the debt ceiling without an agreement to increase it. There's been several instances of drawn out debate about how much it should be increased and how close to that line we got. Specifically in the summer of 2011, which probably for those that are really concerned about what might happen in the next couple of weeks as we approach the debt ceiling limit, might be the most applicable time period to think about from an investment standpoint. So we have a nice chart here from Y-Charts that is just simply showing in 2011 through early 2012 what happened that summer as the U.S. approached the debt ceiling limit and actually came within 2 days, despite all the extraordinary measures that they did that summer to sort of extend the moment until they hit the debt ceiling limit, which was right around early August. What actually happened in the investment markets? The U.S. did not go into technical default. The U.S. has never gone into technical default, but we really pushed the line that particular instance when it came to debt ceiling negotiations. And the U.S. stock market, on this chart represented by the S&P 500, ended up losing about 16 or 17% over a course of several weeks, only to gain much of that back within the next couple of weeks once they did agree to an increase, and then fully recover within a couple of months. The U.S. bond market actually increased in value as investors who were concerned about the ramifications economically of pushing right up to that line. Investors ran and hid to U.S. government bonds like they often do, which is somewhat ironic given that the concern is that the U.S. is testing a debt limit where they might not even be able to pay those bonds back. Now, to clarify, it's not a question of if the U.S. has the money to pay our bonds back. This is not a Greek-style debt crisis where that same summer, actually, 2011, Greece literally said, we are running out of money and we're not going to be able to pay our debts back. That is not at all what's happening in the United States. We have all the money we need to pay our debts back because we have the world's largest economy. So it's really that self-imposed limit that we're talking about. But in summer 2011, the bottom line was, yes, stocks did go down a fair amount in a short period of time, and then recovered much of that also within a short period of time. And bonds, again, went up in value as investors sort of rushed to safety when they were concerned about what was going to happen here. I'm not going to try and predict exactly how this debt ceiling negotiation might work out. How close we'll get to that line is anybody's guess. But I would point out that just in the last 10 years alone, so 2013 through 2023, they have increased the debt ceiling 8 times. So this is not a rare occurrence. This happens once every year to year and a half. And like I said, many times that it has been increased, there was no hoopla about it. There were no market moving headlines about what was happening. In fact, in the last couple of months of 2021, which was the most recent debt ceiling increase maneuvers that happened, there were 3 increases over those last couple of months. And we have another chart here, the same S&P 500 and the same US bond market, showing that that period of late 2021, if I didn't just tell you that there were several debt ceiling increases that happened at that point, you wouldn't really be able to tell that much happened in the markets during that, much different than normal market movements during that time frame. So when you look at the different scenarios of what's happened before with debt ceiling increases and how many times they have happened, how normal of an occurrence it is for the debt ceiling to be increased, and to think about what's happened in 2011, which was arguably the most serious, the closest we walked up to that line of reaching the debt ceiling, it appears that yes, it's possible that markets could react negatively to approaching that line. So the last piece of what we want to talk about is a pretty common question that we're getting, which is, well, what should I do, right? Should I make some major investment change based on what's going on with the debt ceiling negotiations? And my response to that would be a pretty dangerous maneuver to try and, because ultimately that's what you're trying to do, is predict what's going to happen with this particular scenario. And the most likely scenario by far is just at some point over the next couple of weeks results in some level of agreement and negotiation and compromise, and they kick the can down the road another 6, 9, 12 months, and then we talk about the debt ceiling again at that point. But that's the most likely scenario because that's what's happened literally about 90 times in the last 100 years. It's possible they walk very closely up to the line. I think it's almost inconceivable that they agree to just default on the U.S. debts despite having the money to pay the debts. That seems like a pretty bad idea all around and would be extremely foolish from a political standpoint and be very detrimental to the U.S. standpoint. But if volatility happens in the markets, the first thing I would say is I would not try and make market or investment movements right now in anticipation of that, or trying to, what some people would call, avoid whatever volatility might come if things start to get a little hairy. And the reason I wouldn't suggest you do that is because, again, the most likely scenario is they come to a compromise, which could be tomorrow, it could be next week, it could be the week after that. But it's very possible that when they come to a compromise, the stock market cheers that news, celebrates that news, and goes up in value. That's very, very possible. That's happened in a bunch of other times when they came to an agreement. And so if you tried to make a move right now to avoid a downturn by selling stocks, and then the very next day they come to an agreement, then the stock market goes up and you've missed out on that. And you've created a negative financial situation for yourself. So I don't think it would be a wise move to try and shift investments to protect against any volatility that might come in the next couple of weeks, and probably would be short-lived even if it does come. If volatility does show up in an extreme way like it did in the summer of 2011, then an investor's best strategy will actually be to rebalance the portfolios to take advantage of that. If we look back at the summer of 2011, when stocks went down before they came to an agreement and bonds went up, that would have created portfolios to be out of balance, overweight in bonds and underweight in stocks. And so a good move in retrospect, as you look at that scenario, would have been to sell some of the bond profits that you just received and use that money to go take advantage of lower stock prices that only in that particular scenario took a few months to realize a full recovery. That doesn't mean that's how this situation is going to play out, but generally rebalancing portfolios when volatility happens, whether it's stocks going up or bonds going up, rebalancing portfolios has been shown to be a sound investment move over the entire course of the investment markets over the last 120 years. So with that, we just want to touch a little bit on what is the debt ceiling, what happened in 2011, what happened the last time they raised it in late 2021, show some visuals around that with the stock and bond markets, and then speak to how should we be thinking about the next couple of weeks and the volatility that may or may not show up depending on when they come to an agreement, and then what would we do if volatility does actually show up. So with that, that's been a quick market update from us. I'm Steve Elwell, Chief Investment Officer, and have a great weekend.